My name is Sharena, and this is my video assignment. I will do the first two parts in Dutch, I mean English, and then I will go talk Dutch because that will be a little bit easier for me. Or maybe I'm going to do it in English, I don't know yet. So, table of contents. I will talk about types of investment strategies. Then I will talk about trading and investing psychology. And then I will do the technical analysis. And then I will go to trade view. So, types of investing, exploring different investment strategies. Um, So, um, first of all, you have index investing. Index investing is the most common form of passive investing, whereby investors seek to replicate and hold a broad market index or indices. Passive investment is cheaper, less complex, and often produces superior after-tax results over medium to long time horizons than actively managed portfolios. Keeping a uh, keeping a good portfolio is essential to successful investing, like a diverse portfolio. And passive investing through indexing is a great way to diversify. Index fund spreads risk broadly by holding all securities or representative sample of securities in um, benchmarks and exchange traded funds, ETFs. ETFs work like mutual funds that are traded on an exchange, just like individual stocks. They offer investors a convenient and cost-effective way to open a diversified portfolio of assets such as stocks, bonds, and other securities. One of the main advantage of ETFs is their diversification. ETFs typically have the diversified basket of assets that may include a broad market index, industry-specific stocks, bonds of various maturities, or even commodities. This diversification helps spread risk across multiple holdings and can improve portfolio stability. ETFs offer investors simplicity and ease of use, so that's very good. The buy and hold strategy. A buy and hold strategy is an investment approach in which investors buy securities such as stocks or bonds with the intention of holding them for like a long term, also regardless of short-term market fluctuations. This strategy is characterized by a patient and passive approach to investing, which emphasizes a long-term perspective and the belief that the value of the market will increase over time. Buy and hold investors typically have a long-term investment horizon, um, often measured in years of decades. Their goal is to use investment opportunities to increase their value over a long period. Then we have stock picking. Stock picking is when an investor uses this like a systemic analyze to conclude that a particular stock makes a good investment and therefore should be included in the portfolio. This is also called active management. And then we have value investing. Value investing is an investment strategy that emphasizes identifying and investing in undervalued stocks or assets with the expectation that their value will increase over time. Value investors believe that the market can sometimes misprice assets, offering investors the not risk-free and not all undervalued assets may rise as expected. Market conditions, company performance, and financial factors can all affect the success of the strategy. However, value investing is a time-tested approach that many well-known investors have successfully used to achieve long-term wealth investing. So that's good. And then the last one is growth investing. Growth investing is like a stock buying strategy that looks for companies that are expected to grow at an like an above average rate compared to the industry of the broader market or the broader market. Growth investors typically look for investment in rapidly expanding industries or even the entire markets where new technologies and services are being developed. Growth investors tend to favor smaller, younger companies poised to expand and increase profitability potential in the future. Growth investors may use certain methods or criteria as a framework for their analysis, but these methods must be applied with the company's particular situation in mind. And then, so I chose this subject because I think it's important to know which kind of strategies there are before you can really go investing. So you can see which one will work for you, and then you have also like background information about investing. And then trading investing psychology. I think psychology is an interesting subject, so that's why I choose this one. Emotional influences. Fear is a powerful emotion that can lead to irrational decisions, such as selling assets during a panic market crash. Such fear-driven selling can cause heavy losses, as it often causes investors to abandon their long-term strategies based on short-term market fluctuations. Greed can cause investors to take excessive risk in search of higher returns. This can mean buying big assets without proper research or overexploited positions. Such actions can lead to big losses in the event of a market correction. For example, imagine that you decide to invest in real estate. You can carefully research the market, analyze properties, and identify what seems like a good opportunity. However, shortly after making the purchase, there's a sudden economic downturn, and the real estate market takes a hit. Now fear starts to set in. The value of your property begins to decline, and you hear pessimistic news about the economic situation. The fear of losing more money quickly becomes overwhelming. So emotion will take over. Psychological biases. Psychological biases can significantly influence decision making in various areas of life, including business and investing. Confirmation bias is the tendency to prefer information that reinforces existing beliefs or values and to ignore or reject information that conflicts with those beliefs. In investing, confirmation bias can lead individuals to seek information that supports their existing investment decision making and ignore warning signs or evidence to the contrary. This bias can prevent investors from objectively reassessing their position and adjusting to changing the market conditions. Consider a scenario where you can have invested in, like, for example, technology in a technology company and strongly believe in future successes, despite emerging news that suggest potential challenges or negative developments, you may subconsciously seek out and give more weight to information that support your optimistic view, while disregarding conflicting information. Loss aversion refers to the tendency to avoid losses rather than obtain equivalent gains. So yeah, like in other words, the pain of losing is more psychologically powerful than the joy of winning. Traders and loss-averse investors may hold losses for too long and in the hope that for the investment will recover, even though rational analysis suggests that cutting losses may make sense. This can lead to a significant reduction in the portfolio. For example, imagine you bought a stock that is about to decline in value. Because of loss aversion, you may feel a strong emotional attachment to the investment and may reluctant to sell at a loss, even if the stock's fundamentals have weakened. Such emotional attachment can lead to greater loss if stocks continue to fall. I also have that because my crypto is like declining, so yeah, I'm not really happy with it. And I really want to sell it with profit, so I'm still waiting. And then importance of discipline. Discipline is a key component of successful trading and investment. Discipline assures that they stick to your strategy, avoiding impulsive decisions, and it helps control emotions like fear. I will keep it a little bit short because I see I don't have a lot of time. And then positive mindset. Maintaining a positive mindset is crucial for traders and investors as it promotes better decision making. Financial markets can be very volatile, and price can be changed unexpectedly. A positive mindset helps traders and investors remain emotionally resilient during market turbulence instead of giving into fear or panic during an economic downturn. Um, a positive mindset increases self-confidence. Confident traders are more likely to stick to their strategy, take calculated risks, and remain disciplined during times of market uncertainty. A positive mindset improves mental well-being. Traders and investors who maintain a positive outlook are less prone to anxiety and burnout, which promotes a healthier and more sustainable approach to their financial activities. And I think that's really good. Positive mindset is not also about is also you can use it during trading, but also during real life. I think you always have to keep a positive mindset, and better times are always ahead. So now I will, let me see. No. Now I will show another screen if it work. One moment. Let me see if I can do that. Oh,